What does it mean when the Fed raises or lowers interest rates? The Fed is the Federal Reserve Board. That's the central bank of the U.S. government. The Fed prints money and destroys money every day. That's their main tool. Now, when the Fed says that they're going to raise or lower interest rates, what they're really doing is setting a target. They can't control it directly, but they control it by increasing or decreasing the supply and the demand. Now, the banks want to borrow money from the Fed. They don't just keep money lying around that they're not using. They like to loan out as much as they can, and so if there are loans they want to make, then they'll try to borrow money from the Fed. Now, if the Fed has, let's say they want to increase interest rates, they will destroy more money than they're making, so there's less in circulation. Then the banks are going to bid on trying to get that money that's there, and they're likely to bid up the price of it. And the price is the interest they're willing to pay, because the interest is the fee that you pay to be able to borrow money. It's a percentage on what you already own until you finally paid it off. And so when the banks borrow money at a certain interest rate, then they turn around and increase the interest rate a little bit and pass it on to you so they can turn a profit. That's the interest you get on your credit card. So what does it mean for the Fed to raise or lower interest rates? It's when the Fed is changing the amount of currency that's out there in the hopes that that'll get the banks to bid up or down how much interest they're willing to pay to have money to invest.